Welcome back. We're below 25,350, now extending the fall to a 250-point cut. Remember, this is also the Nifty weekly expiry. 40 minutes to go to wrap up what's been a very tough trading session. Jigar Mistry, co-founder Buoyant Capital, is now joining in. Jigar, it's been 12 trading sessions so far since the start of the year, and we've been in the red for 8 of them. And this was the year when we were supposed to reverse some of last year's underperformance led by earnings momentum. What has happened? If you could just, lay out the setup for the markets from here.
Right. Good afternoon, Rima. So I think, see, there are two-pronged problems to this. One is sort of what's happening with the trade and related issues. And secondly, what we reckon is the central engine of India's growth coming under some bit of scrutiny. On the trade and related issues, on the face of it, it looks like a livable problem. You export an equivalent of 2% of GDP worth to the US. And if you assume half of that gets taken out for 6 months, a 50 basis points impact is not that material on GDP. However, what it does to the rupee is something that needs to be looked at because we are now running a serious current account deficit at a time when FIs are selling and FDI is almost net zero. Right, so BOP is negative as well, and it's a vicious sort of circle we seem to have entered in. FIs will not enter unless the rupee and the overvaluation is taken care of, and rupee won't be taken care of until we have a trade deal, and therefore it's gone into a circular spiral, which needs some jolting out. In absence of that, or while we wait for that, the central engine of India's growth was the fact that center plus state plus PSU capex was growing at a very fast step incrementally. And I think we've spoken about this at length over the last year, is that we are finding states are doing a lot more social spending compared to the capital spending that they used to do. And the central government, for the first time since COVID, is finding itself short of revenue to continue doing capex. So we are expecting the capital spending bill for this fiscal year as well getting slashed. If the central engine of growth, which was pulling up India's GDP higher, is slowing down, then you're seeing the impact of that in the quarterly numbers as well. It takes transition for an economy to go from capex to consumption, and we are not there yet. So I think if you combine both those events and then overlay flows on top of it, apparently FIs have sold, promoters have sold, companies have raised money, and the singular buyer is equities, which is singular buyer, is retail through mutual funds and retail direct. Now, traditionally, you would have seen, SIP slow down after a year of underperformance, but this time around, even that is not happening. Otherwise, it would have been a much faster burn compared to the slow burn that we seem to be witnessing. So I think if the market sort of comes to a level where valuations become attractive, and we don't think we are there yet, especially in the small cap piece, I think it's sort of something that we'll continue to expect for the next few months as well.
Jigar, give us a few basic details. As you said, economics are not turning in favor of us. In fact, with the rupee weakening, it's putting us into a bigger problem. And also, we did have a good run, and now we are paused for breath. The question is, how low can we go from here? First, on the headline index, you're clearly telling us that in the broader markets, there is signs of frothiness. For y'all, how much cash are you sitting on? And how much do you think the headline index can correct? Because I think a month or so ago, everyone was talking about at least the headline index holding its own. And now we've corrected close to around 1,000 points from the recent top.
Right, Nigel. So see, while that's not very visible, but more than 60% of micro caps have fallen more than 25% from their highs. More than 20% small caps have fallen 25% from the 52-week highs, even in the previous case. So there is some amount of froth that has been cleaned out. But as I said, if you are going to see a situation where, the flows are holding the ball up, and if flows become challenging, then you will start questioning almost everything. To the second part of your question, as a fund, Nigel, we don't believe in owning a lot of cash. We prefer to lower the portfolio beta through our aggressive and defensive stances. We have been defensive for a while now, as you would have gathered over the last year that we've been having the conversations. We are still not there yet in terms of dialing the risk up, in our opinion. So it's a wait and watch even for us at the moment.
Some numbers you said for small caps, valuations need to correct a lot more. Can you break that up, sector by sector? What are the growth prospects? Where are the valuations looking high, especially in the small and mid-cap universe?
Rima, so see, just before I answer your question, let me give you one more statistic. In that, see, more than 81% of the demat accounts operational today have come in post-COVID. Now, obviously, it's not a seamless one-way move up, but they have seen between 25 and 32% growth CAGR returns in Nifty. They've seen between 40 and 52% CAGR returns in small caps, right? And that was the expectation with which a lot of this money came in. And obviously, you could show them a lot of data that 5 or a 10-year rolling return on large cap or small cap index is around 13%. But unless people sort of experience it themselves, it's not going to come to a reality check for many of us. So that transition away from a 30% expectation to a 15% expectation will take its volatility along the way. And I think that's what we are experiencing today. To your question on where do we see, the growth and value emerging, again, if you're positioning the portfolio to deliver sort of 15, 17% returns, then a lot of sectors become very interesting. Now we calculate that about 6 lakh crores or roughly 1.7% of GDP has moved in the hands of people away from the government coffers, state and center combined. That money is slowly getting sort of deposited into the bank. You're seeing the latest data for deposits grow. And clearly, that is one place where almost all the sort of ducks are falling in row. So, deposit growth is happening. It looks like we have already seen our last rate cuts, and if not, maybe one more. So, NIM compression is behind. Asset quality is largely okay. And essentially, all the cycles are working okay. So, financials is one sector which I think clearly stands out. For the last 12 months or so, besides this, we have increased allocations to consumer discretionary at first, increasingly staples as well. And outside of this theme, I think pharmaceuticals continue to be our largest picks.
Jigar, what happened to the first love? Metals? What's the view out there, Jigar? You have seen many cycles like these. But this seems to be, quite a run that it's had. You talk about the index under pressure, and metals is normally high beta, but it's in a world of its own. There's plenty of excitement. I don't know when's the last time you saw Hindustan Zinc rally like this. Obviously, there's a float factor there. But Vedanta, even on bad days, we're not seeing the stock collapse, telling you that the street believes this metal cycle still has more legs to run.
Absolutely, Nigel. So one part of the story here clearly is the supply shocks we are likely witnessing. Copper complex is the first to give way, and we take you as that being the barometer. But besides this, as we discussed, I think was it last month when we said that this is not just a play on the demand supply of individual commodities, as much as it's also a play on where people think dollar is going. Now, given that the Fed had printed almost 8 trillion worth of dollars since the GFC was not enough, they're using power across media, across spectrums in a way where increasingly this is getting yes, there's only one alternative, but we might as well explore others. So every country is trying to de-dollarize in its own way. If you are India, you'll do it through, say, gold and silver. If you're China, you'll do it through commodities. And there is also a factor where any limited supply commodity, when designated in a fiat currency, most notably the US dollar, will be inflationary over the time to come. Now, these are sectors which a wide gamut of people didn't like to own, and therefore there was always under ownership getting into that rally. But I think, that's a place that we have had significant exposure, and we continue to like a few of those names, Nigel.
Thank you. We leave the conversation here for now. The Nifty is hurtling lower now, 260 points down.